Hi, I'm Paul Merriman. I'm 72. I'm a retired investment advisor. And let me just tell you that life doesn't get any better than this, what I'm here to do today. And let me give you a little background so you'll understand why, while I was taking a shower this morning, I was singing, "Oh, what a beautiful day," because I am truly excited to share this information with all of you. I kind of retired at age 40. I stopped doing the corporate thing and the building businesses thing, and I did what I wanted to do for the rest of my life. I started teaching people about how to invest. Now, I did it while I was starting and building an investment advisory company, and over the 30 years that I built that business, I taught well over 1,000 workshops for the public, all free. I traveled the country talking to CPAs. In fact, in 22 out of 25 years, I went back to Michigan and taught 2 or 3 classes each time at the financial planning sessions that they had, the conference. So I love teaching. And the fact is that whether I'm writing articles, doing podcasts, or working with you here today, it's all about teaching. And it's interesting because to build a business by showing people how to do everything on their own is somewhat unique in this industry. But the fact is, if they're qualified to do it on their own, and many of you are, then you just need to figure out how to do it the best way you can. I hope today will show you some new ways to invest that will mean big rewards for you and your family. And by the way, your clients. Now, when I retired and I sold my shares of my investment management company in 2012, I took a big chunk of that money and I put it into a new foundation. It's a financial education foundation. And through that foundation, my life is really about a handful of projects. And today is one of those projects. But I support a class at Western Washington University, Personal Investing 216. This is a course for non-finance majors so that when they come out of Western, they'll make the right decisions with their 401k investments. In most cases, that's where they use that information. I also write a weekly column for Market Watch, which is a Wall Street Journal site. I do a weekly podcast. I have free ebooks. I have a newsletter goes out twice a month. I have actually analyzed the 100 largest 401k plans and made my recommendations. So all of my work, and by the way, I should mention, I promised my wife when I retired that I would never work for money again. I've been held to that promise, and even working here today, this is for you, not for me. So what are you going to learn in the next this segment and 2 others? Well, here's what I hope you will learn. I hope you will learn the right things to do at 4 different steps along the way, because here's what I think are the 4 most important decisions you will make. One is, in the growth part of your portfolio, where you know that you need stocks in order to achieve better than bond returns, which are the best equity asset classes? I'll make that as clear as I can. Secondly, how much of your portfolio should be in bonds? That's a huge decision because if you don't have enough bonds in your portfolio, the possibility is when the going gets tough in a bear market that you're going to want to move to safety, and you end up moving to safety about the time the market turns around and it goes back up. The third thing I want to teach you or share with you is which are the best performing mutual funds. To the extent that you want to have a large cap value fund or ETF, which one should you own? So I will do my best to help you select the very best index and ETF funds for every one of those asset classes. And finally, in terms of taking care of you, I want to share with you my beliefs, my experience in guiding people in how to best take money out of your investments in retirement. I actually believe that a first-time investor in their 20s should already know what kind of a distribution strategy they're going to use, because if they don't know that, how do they know how much money they need to save? And finally, it's a short piece, but it's a powerful piece. I want to show you how to take, could be a small amount, as little as $100 a year, or $365 a year, or a one-time investment of $3,000, not for you, but for a child, a grandchild, a child or a grandchild of one of your friends or of one of your clients. How you can turn that $3,000 investment or $365 a year into a $50 million retirement. And I'm not kidding. So let's get moving here. Let's focus on something that will, I think, point out what my passion is about helping people. Because people underestimate the power of a little higher return. When I teach the university course and I ask them, do you think a 0.5% difference in the return that you get on your investments for the rest of your life, do you think that could make a major difference? And normally they couldn't see how an extra 0.5% might lead to something very special. Well, here's how special it is. Let's just assume that you're putting away $5,000 a year over a 40-year period. Certainly possible for a 25-year-old person. And what you do is you achieve an 8% compound rate of return. And I think, by the way, that investing conservatively, including some more equities in the early years and less in equities later in life, that an 8% compound rate of return is in fact achievable. So what would you have? If you got 8% a year and then you retired and you started taking money out every year, let's say you took 4% out of your investments to live on. Because the bottom line is, the real value for all of our years of investing are a combination of what we have to retire on, how much we take out, and how much we leave to others. And as you can see by the numbers, at an 8% return over a lifetime, taking 4% out during the retirement years, you would then have about $2.5 million in distributions and almost $4 million to leave to your heirs, for a total of about $6.5 million. But what if? And it's certainly not a what if by doing something unusual. What if, without taking any more risk, you could make an extra 0.5% a year over that same lifetime? Well, it means that you would have more money at retirement. In fact, instead of having $1.4 million at retirement, you'd have $1.7 million, which means you'd take more money out. Instead of taking out $2.5 million, you take out $3.1 million. And then you leave something to your heirs. You leave $5 million instead of $4 million by that extra 0.5%. So what's the final bottom line? Well, the bottom line is, by making that extra 0.5%, you take more out, you leave more to others, by a total of about $1.8 million on an investment of $200,000. So I want to, for you, for your children, for your clients, to make sure that we're doing all that we can to pick up that extra 0.5%. Now, I'd like to take a few minutes, and I'd like to look back at the last 50 years, because I think it's important for you to understand how the business has changed, and why investors today should easily be able to pick up an extra 0.5%. In fact, I really believe that probably an extra 2% is available to investors today if they do it right, compared to when I came into the industry back in the 60s. What did we see back in the 60s? Well, in the 60s, commissions were very high. In fact, commissions were regulated. I could earn a $700 commission. Well, a part of that was mine when I was a broker for a couple of years back in the 60s. Today, that $700 commission can be traded for under $10. Commissions on mutual funds have fallen by 30 to 50%. Back in the 60s, they got over 9% commission load on a mutual fund. Today, that can be down as low as 4, but even better than that, today we have no-load mutual funds that allow us to purchase without any commission at all. And in equity funds, for what it's worth, that in and of itself will probably give you about an extra 0.5% a year in the equity part of your portfolio, just getting rid of that commission. Mutual fund expense ratios were over 1% in the equity part of the portfolio. In fact, they're still over 1% with a lot of the mutual funds that you could go out and invest in today. But at the same time as there are managers who are charging over 1%, there are now mutual funds and ETFs where the expenses are as little as 0.1% and less. And during that 50-year period, we've started to have IRAs and 401ks available to us. And then index funds, 1976, John Bogle comes in and blows the investment community apart, even though they fought him for years, thought it was silly that somebody would want to put money into an index fund. Well, as you know, index funds have become the investment of choice. And in the beginning, it was only the S&P 500. But today, you have access between mutual funds and ETFs to literally dozens of different asset classes at very low expenses. We did not have Money Magazine and Wall Street Week. Remember Louis Rukeyser and Wall Street Week? In fact, one of the most fun days of my life was I got to go and be on the Rukeyser show. By the way, he was not interested in my returns. He was interested in what I had to teach, which was the right thing for him to be interested in as far as I was concerned. In those days, if you had 10 to 20 stocks in your portfolio, I'm talking about 50 years ago, you were properly diversified. Today we know that you need thousands of stocks in your portfolio. In fact, when I look at my own portfolio and I look at the 10 different equity funds that I own, I have between 10 and 15,000 different companies in my portfolio, and I'm properly diversified. We didn't know anything from the academic community. We had no academics teaching us how to invest. We did it the Wall Street way. One of the reasons I believe that investors back then only probably got about half of what they should have is because they were doing it the Wall Street way. Well, today, and over the last 50 years, we've been introduced to academic research that absolutely has changed the whole investment process. Dr. Fama, Dr. French, and their work with small cap and value. Almost everybody today has some piece of their portfolio in small cap, some piece in value. And I'll be talking in a while about how much you might want to have in your portfolio. And then we've gotten target date funds. I mean, target date funds allow you as a 21-year-old to be able to put your money in one fund and leave it there for the rest of your life. You don't have to worry about the market going up and down. You don't have to worry about rebalancing. All you have to worry about and figure out is when are you approximately going to retire, and the professionals will manage that money so that as you get closer and closer to retirement, that you have more bonds in your portfolio. In essence, it's like a pension fund, but for an individual. And then exchange-traded funds, 1993, they started. And now we have the ability to own what is basically a mutual fund, but it can be traded during the day. Now, for many investors, I'm not so sure that's a good idea to be able to trade mutual funds, in essence, during the day. There may be some calm and reason that comes when you can only trade once a day, but it has opened up a whole new field of investing. In fact, today, with $1,000, you can put your money into 10 different ETFs, $100 each, into 10 great ETFs, and not pay one commission to buy and not pay one commission to sell. And here's what probably is the most important point of all. During that 50-year period, there was a huge move from the investors thinking offense when they're investing. When they're thinking about making a lot of money, they're thinking about taking risk and being offensive. Well, it's a fascinating change to me. But today, it is about defense. That if you look at how successful investors invest, they aren't offensive anymore. They are, in fact, defensive. Let me show you some examples of defensive investing. Give you some choices. In my book, 101 Investment Decisions Guaranteed to Change Your Financial Future, I address 101 forks in the road that every investor is going to take by either design or by default. And then we decide, based on best practices, which direction should you go. And when we break it down to simple pieces like that, I think it makes it a lot easier for people to decide how they should invest. If you ask people to make 100 decisions at one time, that's not going to work. But how about if I asked you whether it is offensive or defensive to own one fund, one stock, one company versus many? What's the smart thing to do? Well, if I told you the academics have determined that the expected rate of return of any single stock is the same as the average rate of return of 1,000 stocks, would it make sense to buy one company? No. You buy the 1,000. Now, of course, investors can't imagine that the stock they pick would not be a big performer. But that's what we all think with individual stocks, that we hold the right stocks. But in fact, the expected rate of return is the same. Go with the 1,000. Choice, one industry or many. I've got a good friend who worked in the banking industry all of his life. And he trusted that business because he knew that business. And his favorite bank was WAMU, Washington Mutual. Well, we know what happened to WAMU. It didn't make it. And so all of the evidence is the smart way to invest would be many industries, not one. Many asset classes, not one. If you had all your money in large cap growth from 2000 to 2009, for 10 years you lost money. If you had a diversified portfolio of many different asset classes, I'll talk about them in just a few minutes, you would have had about a 7 to 8% compound rate of return. And that even in terms of choices of one versus many, you've got to make the decision. Should you be in one company? Or should you, one country, or should you be in many? Well, I think we know, in fact, people do have a home bias. It's fascinating to know that people in New Zealand and in Greece have invested most of their money in their own countries, and yet they represent a very small part of the global stock market. So the academics tell us, by the way, that we should never have more than half of our money in any one country. And it's normal for countries to believe in people in those countries that they are on top and they're on top forever. Think Japan. Japan was the powerhouse stock market for 20 years. And then it wasn't for another 20 years. So diversification amongst countries. You want to be, now by the way, we're thinking defense here again, defense. You want to be in mutual funds that have high expenses or low expenses? Well, I asked my high school students which they would choose. They know they choose low expenses. And yet people still today invest major parts of their portfolio in mutual funds that have high expenses. Would you want a mutual fund that has high turnover, lots of buying and selling going on inside of that portfolio? And I think a lot of investors would say, sure, as long as they make me more money. But it turns out the studies show that those mutual funds that have a lot of turnover, they do not make more money. They make less. What about taxes? Would you like to be in a mutual fund that produces less tax efficiency or more tax efficiency? Well, the defensive way, obviously, would be more tax efficiency, less in taxes. And then we want to know a big one: passive versus active mutual funds, managed mutual funds. And this has become a debate that the tipping point, I think, has been reached, and the majority of people have come to the conclusion, as I think you should too, to put your investments in passively managed funds and ETFs. And I'll talk more about that in a while. And the final point about these defensive steps, and I'll be talking about this in specifics when we get to the part of the presentation on distributions. It turns out that being defensive and adding bonds to a portfolio, causing the return to go down, can actually make you more money. It doesn't necessarily make sense, but wait until you see the numbers. With all this good stuff that's gone on over the last 50 years, all these new products, all these smart people, why is it that investors have got some major, major challenges? Well, the first one is that pension funds are folding, and people are being asked to take care of their own financial future. In the 60s, about 80% plus of the large corporations had pension funds. Now it's about 20%. So you can't count on that anymore as a source of income in retirement. And then there's your savings rate. It's shocking when you realize that in the mid-60s, people were saving, on average, 11%. Today, that average is up from about 1.5 back in 2007 to a little over 5 now. We are not saving enough. Now, if you invest intelligently, maybe you'll get by on saving too little. But I'm suggesting, 1, you save more, and 2, that you invest more intelligently, at least based on looking at the past. You and I both know I can't tell you anything about the future. I can only be an expert on the past. And then we have to face what may be the biggest challenge of all, and that is the challenge of that person you look at in the mirror every morning when you get up, and that's your psychological challenges with investing. And I want to show you a table here. I'll just spend a minute on it, and I hope when you have time, you'll not only take some time to dig into this table, but you'll look in the supplemental information about this organization and what's behind this study. Let's just look at the 30-year return of equities. Under equity funds, it says 3.66. According to their study over the last 30 years, U.S. equity funds, the average return of U.S. equity investors was 3.66%, while the S&P 500, as you can see, compounded at 10.35. How can it be that most of the money was lost somehow? Why couldn't people either have the patience or the smarts to put their money into the S&P 500 maybe and leave it there? Because life is more complex. When it comes to sex, food, and money, those are not intellectual decisions, folks. Those are emotional decisions. And the emotions of investing can turn people inside out. And I know after 30 years in the investment advisory business that you can develop a portfolio that gives investors the peace of mind that they don't have to jump ship when the going gets rough. And there are other reasons for that difference. For example, bad advice. If you looked at all the people who are giving advice, there's got to be an 80-20 rule in there somewhere where 80% of the people are giving bad advice and 20% of the so-called professionals, many of them professional salespeople, not professional advisors, are giving bad advice. Your job is to find out where to get that good advice. I'd like to help. I don't want to manage your money, but I'd like to help you figure out who can give good advice. This next table is probably the most important piece I've ever done. Did it years ago, and updated it every year. And it's my best attempt to help investors find the right asset classes to put into their portfolio and to figure out how to diversify them in a way that is likely going to give you the return that you need. Now, these numbers are fairly small here for me, so I'm going to have to look down from time to time and find the right number for you, but you've got the numbers there. I want to take you through that table. Portfolio 1, it's the S&P 500. It, by the way, is the asset class that experts say very difficult to beat. Most people can't beat it. Warren Buffett, in his will, has left 90% of what he's left to his wife to go into the S&P 500. So it's obviously not a bad place to invest. It just isn't the most profitable place historically to invest. So I want to have that in the portfolio, but you can see over the last, from 1946 to 2015, the compound rate of return was about 9.3%. But what if in Portfolio 2 I took a baby step? And that baby step is to take just 10% of the portfolio and put it into large cap value. Now, value, those are companies that are out of favor. Those are companies that sell at a relatively low price compared to their book value. Growth companies tend to be higher prices compared to their book value. The academics have ferreted all this out. None of this is unique to me. It's not my research. It's some very smart people's research. But what would happen if in Portfolio 2, all we do, take a little bit of the large cap value, so now it's 90% in S&P 500 in Portfolio 2 and 10% in large cap value. Look what happens. The return goes up 41 basis points, 0.4%, and the return, instead of $100,000 growing to $5.8 million, $100,000 grows to 6.9. A $1 million improvement over a 46-year period. One step, and a baby step. Not asking you to take a big risk. Oh, and by the way, I should mention, the standard deviation, the volatility has gone down in the process. That's good. Better rate of return with lower risk. That's what we're all after. All right, let's make another addition. Let's add some small cap blend, SCB, small cap blend. These are companies of probably about $1.5 billion and smaller or a little larger. And they're going to be more risky one by one, so they're going to be more volatile one by one, and they'll also be more volatile as a fund. They'll be more volatile. By adding that, you add a little bit of extra return, 0.15. If I could figure out a way to get you 1/100th of 1% without doing anything crazy in terms of risk and that you would get a higher return, I'd take it. But in this particular case, it goes to now 9.81, 15/100ths of 1% more return, and it drops about another $500,000 to the bottom line. I want more. My favorite asset class, small cap value. I prefer U.S. small cap value because I think people are more comfortable with it than international small cap value, but it's still small cap value, small companies that are basically out of favor for some reason. So this is not low risk, but when you buy 1,000 of them, or sometimes in some portfolios, you might get an ETF or a fund that has 2,000 of these companies in one security. That 10% addition takes the return up to 10.36 or another, 10.23 or another 42/100ths%. Now remember, I was wanting to find an extra 0.5% for you, just a half. I have found with these 3 steps almost 1%. But there's more. If you add REITs, real estate investment trusts, they are more conservative, certainly, than small cap value, and they make a little bit more than the S&P 500 over the long term. But by adding them to the portfolio, which means you're taking some out of the S&P 500 again, you take the return up to 10.36. And now you have, at that point, that's portfolio 5, you have 60% at that point in the S&P 500 and 40% spread across those other asset classes. Now, to stop all of this from, one at a time, I'm going to dump 4 of them on you at one time. International large cap blend, international large cap value, international small cap blend, and international small cap value. One fell swoop, 10% of each of those asset classes, and now that would be portfolio 6. Compound rate of return is now at 11.09. You have just added almost another 1% to the return. I mean, we're talking about real money for the rest of your life. And to the extent that you find the real money, your heirs find the real money. I mean, you could start a tradition in your family that will impact your family for generations. And it's just baby steps to get there. And finally, the last asset class that I'd like you to have in your portfolio is emerging markets. Because emerging markets, what do they give you? They give you access to, what maybe the United States was like a long time ago, potential of great growth. It adds 19/100ths%. So now, you started with 100,000. It grew to $5.9 million in the S&P 500. And every time you added more of these asset classes, the return to you went up, so that the final portfolio, instead of $5.9 million, is $13.6 million. Now that's the past. We can't buy the past. There's no risk in the past. We know exactly what we should have done in the past. I've laughed about that for years, because in the Pacific Northwest, you tell people, don't invest in anything until 1986 and take whatever you have and put it all in Microsoft and sell in 2000 and put it all in Google. I mean, when we look back, we know exactly what we could have or should have done. But this approach is based on what the academics tell us from past history, and I'm going to show you more past history in just a few minutes. And the reason that this other past history is important is because the longer the statistics that we have, the period to look at, the more meaningful the numbers are. We all understand the concept that 1 year doesn't mean anything. In fact, I'll show you how meaningless 1 year is in just a few minutes. But it's not even 10 years is all that meaningful. 40 years, now you're talking about something interesting. But I will show you 88 years of performance, so you can even get a better idea about what you should be able to expect from this portfolio. Now, I'm working on an article right now. I'll tell you about it. I hope that all of you become subscribers, free, by the way, to my newsletter, so you will know when I come out with a new study that shows the impact of only investing in value over this period of time. What if instead of having growth, because growth gives lower rates of return over time than value does, what if you just put all your money in value? Big, small, U.S., international, even a small slice in emerging markets? Well, I can tell you without even doing the study, you're going to end up making more money. The question is it smart to start to reduce the amount of diversification? Well, of course, only history will tell. We don't know. But I do know this. If you build a portfolio the way I'm suggesting, and I'm only talking about the equity part here, if you build a portfolio that way, what's going to happen is, because you'll have large, you'll have small, you'll have value, you'll have growth, you'll have U.S., international, you'll have REITs, you'll have emerging markets. Here's what could happen. It could be over the next 40 years that growth beats value instead of value beating growth as it has over the last 88 years. But guess what? If growth does better than value, we got it. If large cap does better than small cap, guess what? We got the large cap. Now, we may wish afterward that we put all of our money in large cap if large cap wins, but that's just a game we play with ourselves. That's a what if, shoulda, coulda, woulda. Meaningless. We can't buy the past. So my belief is that for most people, the smart way to do this is to keep it well balanced between large and small, between growth and value, between U.S. and international, playing no favorites with, of course, that slice of REITs and that slice of emerging markets. I update this table every year. As we go through the rest of my presentations, I will be using these results because I'm going to assume that when I build a table of returns, that we're going to use a broadly diversified portfolio. And I'll also compare it along the way to the S&P 500. So all of the numbers depend on this research, and all of this research came not out of Wall Street, came not from my neighbors and relatives, but came from the academic community. And so this is what I think is the right way to do it. Now, I'll make one comment about the right way to do it. In the next segment, I'm going to focus on 4 asset classes, U.S. asset classes. No international, and by the way, no REITs, because I'm going to take the returns back to 1928 of these 4 U.S. asset classes. And the reason I mention that is because many of you probably have a difficult time with the idea of having half of your money in international. You don't have to have any money in international. It is just according to the past. It would have been smart. You would have made a little more money. You would have taken a little less risk had you had the internationals in your portfolio. So that's a decision that you can make. I understand, having been an investment advisor for about 30 years, that you have to, as an advisor, address each individual investor's biases. And to make life even more interesting as an advisor, you are very often sitting across the table from a spender and a saver, a husband and a wife. and they have different senses of peace of mind. So the job of any great advisor is to figure out, how do you take this couple across the table from you and help them negotiate the best portfolio that you can. How much in equities, how much in fixed income. In the next segment, I will show you the how much in equities and fixed income. And then I think you've got to address, as I will in that segment, how much you're willing to lose. And very often, in my experience, when I'm sitting with two people, they don't come up with the same number. One is willing to lose nothing, and one is willing to lose 50%. And hopefully this table will help you make that decision. I'll see you in the next segment. Well, I want to start this segment by saying thank you. Thank you for joining me, and thank you for putting up with all these numbers. Now, I trust that of all the people I talk with, retail investors, industrial people, people in the businesses, that CPAs above all should find these numbers of value. I am an absolute believer in evidence-based investing. I know what Wall Street believes. You sell the sizzle, not the steak. This information is not about the sizzle. It is as much as I can about the raw meat and the basics that give you the highest probability of success. Anything is possible. We know that. And Wall Street is able to put together sales pitches that make things that are unlikely at least sound possible. Well, I only want to be able to identify the probabilities. So, in the first part of this segment, I want to talk again, not so much about combining internationals, but as I said before, the U.S. aspect of the portfolio, because that's where I can go back to 1928. And in the four-fund solution table, what you have is the results for 1 year, just 1 year at a time, the compound rate of return, and the best and the worst of times. And why should I even want you to see a table about 1 year at a time? And the reason 1 year at a time is important, I think, in terms of creating expectations, is that we need people to understand what that short-term emotion is going to likely be like when the bad times come. Nobody complains about the good times. It's only the bad times that we have to deal with. So on this page, I'm going to look at the large cap blend, that's the S&P 500, the large cap value, small cap blend, and small cap value, and then I'm going to create a single investment of all four funds. Now, what do we know about these four asset classes? Well, if you looked at them, what you would see is they have different levels of volatility, and along with that, they have different levels of risk. For example, the large cap blend compounded for 88 years at 9.7%. That's a very fine return. It's about double that of what you would have achieved with bonds. So it was worth the risk. The premium was certainly worth the risk that you took over the long term. When you look at large cap value, the compound rate of return was 11. That's a big increase. Let's always go back to that extra 0.5% and how much we appreciate that extra 0.5%. Small cap blend, 12. An extra 1% was small cap blend over the 88-year period. And finally, the small cap value, 13.4%. From 9.7 to 13.4 for 88 years. Put the four together, 11.7. Now that would be one of the finest returns that investors would get over a long period of time. Remember, most people invest in the S&P 500 in those large, well-known companies. So had you gotten, you would have had 9.7% with things you know and you like and you trust. But you would have had a huge premium, 2% a year premium for the four-fund solution. But what about the best year? Not that we care about the best year because that's not going to cause us to quit the process. But the best year for large cap blend was a gain of 54%. For large cap value, a gain of 92.7%. For small cap blend, 110%. For small cap value, 125%. And the combination of the four, 96%. And notice what year that was. 1933 for every one of them. Now remember, 1933 was after 1932, which was after 1931 and 30 and 29. It was a bloodbath. But as so often happens after the bloodbath, whether it's 73 and 74, 2000 through 2002, 2007 through 2009, after the big decline, the market comes back and comes back strong. But let's look at the worst year. A loss of 43 for the S&P, a loss of 62 for large cap value, a loss of 48 for small cap blend, a loss of 54.7 for small cap value, and the average of the four, a loss of 51.8. Well, let me tell you what the smartest people in the industry have said. And I'll just use two of them. Warren Buffett and Peter Lynch, they have both said, if you're not willing to lose half of your money, you shouldn't be in stocks. Now, I'm 72. I don't want to lose half of my money. So does that mean I can't be in stocks? Or does it mean I have to be smart and put enough into bonds to address that amount that would allow me to stay the course when this kind of bad stuff happens? Here's something I think is very interesting. The difference between the best and the worst for the large cap blend was 97%, a plus 54 and a minus 43, 97% difference. And that tells me that year to year, the difference from one year to the next can be just huge. Look at the four-fund solution. The difference is from 96 to a minus 51.8. That is 147% difference in return. 1 year is noise. Now, it doesn't feel like noise if the market goes down. I understand that. But it has so very little to do with the expected long-term return. But it is that short-term performance that causes people to get emotional and make decisions. Remember, sex, food, and money are about emotions, not about the intellect. Well, what else do we know? Well, we know that about, 64 of the years, large cap blend made money, 24 it lost money. The four-fund solution, 62 years it made money, 26 years it lost money. About a third of the time, you should expect to lose money in even a diversified portfolio. And that is something we should expect. And when it happens, and your spouse says, oh my God, wouldn't we have been better off in CDs last year? Your answer is yes. 1 out of 3 years, we should be better off in CDs. That's the way it works. So, let's now look at going out further. Now we're talking about something that's a bit more meaningful, and I'll tell you who I think it's meaningful to. I think it's very meaningful to people who might be 15 years away from retirement or in retirement. At age 72, I guess I'd be looking for a 20-year performance to deal with how much time I think I have left. So different people want to see different periods of time. So let's see, what do these four assets, or as a group, how do they perform over longer periods of time, both on average and during the best of times and the worst of times. So as I look at the average compound rate of return of the large cap blend over 15 years, 10.9%. Large cap value, 13.1. Small cap blend, 13.8. Small cap value, get this, 16.1. That's a huge premium. And what the academics said years ago is there is an expected premium from small cap value of about 5% a year over the S&P 500. And guess what it did? It gave it. It did that. And it did it over a long period of time. But you put the four funds together, 13.6, with very similar risk characteristics with the S&P 500, by the way. Now, I want you to notice something that happens. Let's look at the best and worst year for large cap blend. By the way, not the worst year, but the worst 15 years. The best 15 years for the large cap blend was a gain of 18.9 versus a gain compounded of 0.6. Now, all of a sudden, the worst of times actually shows a gain. It's not a very good gain, particularly if you're living off of that money in retirement, and let's say, for the sake of discussion, that you're taking out 4% a year. This isn't good at all, but it's what's likely to happen at some point in the future. But notice the difference between the best 15-year period and the worst 15-year period. It was about 18%. Now, we started out with a difference of 97% over 1 year, but we came way down to 18% once we're talking about 15-year periods. And this is the way it works over time. The longer the period of time you look at, the closer the best and the worst come together. Let's just, for the sake of discussion here, go over and look at the four-fund solution. And you will see that the average, as I said before, 13.6. The best was a 22.1% compound rate of return. And the worst was a gain of 0.5% per year. Interesting. That's virtually the same worst situation as you would have had with the S&P 500. That says to me, at least in theory, that if I take the risk of putting all four of these asset classes together, that at the end of a 15-year period, the worst case may not be any different, but the compound rate of return that's expected over time is hugely different. And between the best and the worst, the difference now, instead of 147%, as it was with 1 year, is down to 21.6. By the way, you will see that there is a typo there. It shows on the large cap value through the four funds that the time period was 1975 to 1889. Well, you know that's 1989. How do those things get in there? I've never understood that. Look at it 1,000 times. It's still there. Okay, looking down towards the bottom of the page. Notice that when we look at how many periods where it says equal to or higher than 10% compound rate of return, about 6 lines up from the bottom. Notice that there were 43 periods, 43 15-year periods that large cap blend made more than 10. There were 31 year periods that it made less than 10. Now, why is 10% such a big deal? We have it drilled into our heads by the industry that if we're in the stock market, we should be able to make 10% a year. Now, that obviously is not true. The S&P 500 from 2000 through 2009 compounded at a negative 1% a year. Talk more about that later. In those 31-year periods that you made less than 10, the average return was 6.4. Now again, I want to compare these numbers to the four-fund strategy. And you'll notice that instead of 43 15-year periods they produced better than 10%, there were 61. And the 13 that were less than 10%, the average was 7.2%. So what that says is that not only do you make a lot of money in the past, but you also appear, even in the worst of times, to do better than simply having your money in the S&P 500. And I should note that the expected rate of return of the total market index, well, not even the expected, when I look back to 1928, and the academics have put this together, the return of the S&P 500 and the total market index are virtually the same. Some periods the S&P does better, some periods the total market index does better, but long term, what you see here for the S&P 500 would be very similar to the total market index. And I know that a lot of you likely use that in your portfolio. All right. Now we talk about a period of time that I really like, because almost everything looks good. And if I'm going to try to get you to do something, it's always easier to get you to do something that no matter what you do, it's good. But look at this page of 40-year performance. The compound rate of return for each of these individual asset classes is fairly similar to what you saw before. Large cap blend at 10.9, large cap value at 13.5, small cap blend at 13.7, small cap value at 16.2, and the four-fund solution, 13.8. So that's about what you saw before. But what changes is that in that 40-year period, okay, you have a war, okay, you have a recession, okay, you have some sort of a crisis or another, don't know what it's going to be. But when we look at all of the 40-year periods going back to 1928, what we see is the best 40 years for the S&P 500 was a gain of 12.5%. The worst was a gain of 8.9%. Whoa, really narrowing now. So for planning purposes, for young people who definitely have 40 years ahead of them, they can get a pretty good idea of what that range of return is likely to be. And now instead of an 18, well, remember originally it was what, a 97% difference, then it was an 18% difference. Now it's a 3.6% difference from the very best to the very worst. And I can make some pretty good decisions when I know I've got that money there for the long term, and I can see these kinds of relationships. I see, for example, that with the large cap value, the best was 15.8, the worst was 8.3. The best for small cap blend was 16.7, the worst was 10.7. For small cap value, the best was 19, the worst was 11.8. All numbers I can live with. And again, those one-year returns that just turn us inside out, even 5-year returns that turn us inside out, if we are a young investor, we have to figure out how to ignore that noise. And I know it's not easy. And I believe the more you know about this process, the easier it gets. That's why I consider an education to be the greatest leverage we have in helping investors. The leverage of education is amazing. I'll show you that in a few minutes. The four-fund solution, a high of 15.9, a low of 10.7. Yes, a little more difference in those returns than with the S&P 500. The difference is 5.2% range versus 3.6, but it's higher. And by the way, look at this. 6 lines up from the bottom. That 10% or better, equal to or better than 10%, 37 of the 40-year periods, the S&P 500 large cap blend did better than 10. But in 12 periods, less than 10. On average, not much less than 10. On average, 9.6. On the other hand, when you go across to the small cap blend or the small cap value or the four-fund solution, you would notice that in every case there was not a 40-year period that you made 10 or less. You made 10 or better in every period. And by the way, I really don't know what more I could say in order to make the case for adding these asset classes. I will warn you, I think this is very important in terms of expectations. From 1970 to till 2000, small cap blend underperformed the S&P 500. Now, it didn't underperform by much, but it was supposed to have a 1% advantage or something like that. What happened? And when you ask the academics like Dr. Fama, Dr. French, what's wrong? Is your research wrong? Did you come to conclusions that turned out that you were just flat wrong? And their response, talking about that 30 years, was, you're not very patient, are you? I love that response. Because, see, we think, all of us, that 30 years certainly ought to get us what we deserve. And what happened in the late 90s? All sorts of articles written by the experts. The small cap premium is gone. In fact, the value premium is gone. Because during the 90s, large cap and growth were so powerful. And what followed that? A 16-year period that small cap was way better than large. That value was way better than growth. And I'm very proud of an article I wrote in January 9th, 2000, in which I wrote, this is not a new era. Things have not changed. Well, you know what? Maybe they had. But I believed at that point, as I do today, in the longer-term results, not the short-term results. But that doesn't keep me from being wrong. All right. Now we're going to go to a tool that I honestly believe is one of the most powerful tools I ever had available to me as an investment advisor. And it's one that we developed to show prospects, and when we had clients who were becoming uncomfortable with the amount of decline in the market, and maybe they had said they were willing to lose 20%, they had lost 10%, and they were rethinking the 20%. We'd haul this table out, and we update it every year, have been updating it, I think, for about 15 years. And on this table, I have the ability as an investor to look at all the combinations from all bonds, 10%, 20% equity, 30%, 40, 50, 60, all the way to 100% equity. You can notice that across the top of the table. And I have the S&P 500 there so that I can show the return of the all-equity portfolio compared to what people consider to be the benchmark. In fact, I can compare any of these combinations to this benchmark. And you'll find out that benchmark is not all it's made out to be, particularly for retirees. That's for the next segment. But now, for this segment. So you can see how this table is set up. Now, you're only seeing a small part of this entire table with this slide. And I will slowly work through other parts here as we look at periods. In this particular period, we're looking from 1970 through 1979. And we're looking at how did an all-bond portfolio do? How did a 50-50 stocks and bonds, half stocks, half bonds? That happens to be where my wife and I have all of our investments in the 50-50. That meets our risk tolerance and desire for return, all the way over to 100% in stocks, and of course the S&P 500. Every one of these slides has at least one good lesson. The lesson I would want to point to on this particular page is to look at the years 73 and 74 with a portfolio that's 50-50. Notice between those 2 years, you lost about 16%. And the market, if you read the financial press, popular press, the economy, the market, everything was coming to an end. Likely going to be a depression. And of course, the market turned around and took off after 74. And when you go all the way over to the right side there, the 100% stock, the S&P 500, between those 2 years, they both lost about 37%. Now, sometimes it takes a year to lose 37. Sometimes it takes 2 years to lose 37. Maybe it'll take 3 years to lose 37. But remember, that 50% decline is built in there. And I want you to see down the years 77 and 78. I'd like you to look down to the results of the all stock, 100% stock, and the S&P 500. I want you to see that the broadly diversified, big, small, value, growth, etc., made about 65% between those 2 years, while the S&P 500 lost 1%. Was I a genius if I got that for a client? By the way, I wasn't even in the business yet. But had I made that for my clients, would I have been a genius? No. Would I have been a dog if I put my clients into the S&P 500? No. In fact, one of the things that every advisor should come clean with, they should be willing to tell their clients, their prospects, their friends, who are all interested in what they believe the market is going to do next. They should say very clearly, I have never made a penny for my clients. Never. The money that my clients over the 30 years that I worked in this industry, I didn't make that money. The market did. Now, I might have put my clients in markets that made money, but once I put the money in there, I had no control. You would have no control over what they make. And by the way, that's a reason that broad diversification is a prudent, smart, savvy thing to do. Let's look at the next page. We're going to go from 1980 to 1989. Big lesson here to me is 1987. Why? Because 1987 included in it another end of the world event, October 19th, 1987. In one day, the market goes down 22.5%. One day. What conclusions do you draw from a one-day loss of 22.5? If it does it 5 more days, I'm totally broke. That's the kind of conclusion that people came to. People were even worried about whether money market funds were safe. I was in the business at that time. And it was a catastrophic event. Stockbrokers just simply stopped answering the phone. And I find it interesting that a lot of people don't even know about that, and yet it is a part of your future. It's baked into the cake. Those things happen from time to time. I'm not exactly 22.5%, but an amount that will cause a lot of people to become unglued. Here's what's fascinating as we look at 1987. Do we have any emotion when we see the S&P 500 is up 5.2, that we see that the worldwide equity is up 15? Do we have any sense of doom and gloom when you see the 50-50 strategy is up 9.7? And all the fixed income up 3.1. Interestingly enough, the people who were all in fixed income thought they were really smart to have stayed out of the market in 1987. Turns out they weren't. Well, in hindsight, we know that, of course. They might have been really smart if the market had lost 50%. But well diversified. Let's now look at 90 to 99. This was the golden years. They were the golden years for the S&P 500. Amazing years. In fact, from 1995 to 99, the S&P 500 compounded at 28.2%. People were surveyed in the late 99, early 2000, asking, what do you think the next 10 years should bring in the market? The average was somewhere between 20 and 30% a year. Because for 10 years, 28% plus. For 25 years, the compound rate of return of the S&P 500 was 17.2%. Why should we expect anything? Okay, it could be a terrible 10 years and we'd only make 10% a year because that's the historical average people talk about. And I can tell you it was hell trying to manage people's expectations in 1997 and 1998. I was in the business then. I did have people in all equity portfolios. And in 97 and 98, while the S&P 500 was up 33.4 and 28.6, a total of about 71.6%, with all the great work I was doing, my clients made about 9%. Do you know how popular you are when your clients' neighbors are making about 8 times more than they are? And I remember going to what they call a money show down in San Francisco. I was there with my son, who was in business with me. And we had people coming up to our booth and saying, why would anybody want to be in anything but the S&P 500? And I remember one person came up and said, why would anybody want to be in the S&P 500? Because the big money was in the biggest 50 companies. Remember technology? Mm-hmm. Well, for what it's worth, if you want to have realistic expectations between your returns and the S&P 500, I don't care whether you're 50-50 stocks and bonds or you are 100% diversified amongst worldwide equity asset classes, you are not going to look like the S&P 500. In fact, the average difference between the 100% stock portfolio here and the S&P 500 on average is over 12%. And invariably, I always got the question, if we underperformed, is there something wrong? Maybe things have changed. Maybe history doesn't mean anything anymore. Then that was all followed by this next 10-year period. It's amazing that the S&P 500 went from making it wasn't amazing at all. It was normal. After making 17.2% or 28, whatever period of time you wanted to look at prior to 2000, everybody had a sense that this is where you should have your money. And then for the next 3 years, 2000 through 2002, the market was down 42%. And somewhere in there, it was down over 50%. Because in both the 2000 through 2002 bear market and the 2007 through 2009 bear market, there were losses on the S&P 500 of more than 50%. Now, did I look like a genius? Well, not exactly. Maybe I would have been seen as a genius if I actually made money during those 3 years. But if you look at the total return of those 3 years with the worldwide strategy, the big, the small, the value, the growth, because value did well after having not done well for years. Small cap did well after not having done well for years. International did well. And so our loss was about a third of the loss of the S&P 500. And I also might note on that page that in 2008, which was a terrible year, the S&P was down 37%. Is it not interesting that the loss in 2008 was about the same as the loss in 2000 through 2002? This took a different length of time to get there. But I noticed that the 50-50 strategy lost 19.9%. Not so dissimilar from what happened in 73, 74. And I'll share one other number I might forget to share with you because I think it's just kind of interesting. We all think of the Depression, there's this terrible time, everything fell apart. Well, it did. The economy fell apart and people were out of work. It was a terrible time. But just in terms of raw investing, if you look at the 10 years from 1929 through 1938, or 39, 11 years total, I guess. Anyway, it's inflation adjusted, a gain of about 1%. From 2000 through 2009 on the S&P 500, it was an inflation-adjusted negative 3.4%. We lived through a period that in terms of the stock market was worse than what they lived through between 1929 and 1939. And then we have the last 6 years. And there's one lesson here that is I find very interesting because if you look at the 100% bond portfolio, I'm just going to give you a number that you haven't seen yet, but you're going to see it in a minute. Over that whole 46-year period, the intermediate term bond, U.S. government bond, compounded at 6.2%. The last 6 years, the compound rate of return was about 1.9. So as you see the results in a second, and you see that 100% bonds would have made 6.2% over the 46 years, what do you do with that? Is it the least bit meaningful? Or is this 1.9% what we should focus on? And if that's all we're going to make on fixed income, well, gee, I'll go ahead and take the risk of being all equities. And that's a trap. And this is one of the, nobody has the answer. You know that, of course. Nobody can see the future. There are a lot of people who pretend they can, and they'll tell you about how they called this move in the market and that move in the market. But there actually is no evidence that anybody with any degree of consistency is able to call the ups and the downs in the market. And all the famous investors like Warren Buffett and Peter Lynch and Benjamin Graham and others, they say, how would I know? I have no idea where the market's going. I just put my money into what I think are good companies for the long term. And all I'm suggesting is forget about trying to find those companies. How can you know what a company's going to do for the long term? How about just finding good asset classes for the long term? Is that doable for amateurs like the rest of us? Of course. Now we get to the outcome. This is huge, I think, because I'm back to this idea of how do we create realistic expectations. When I show you these numbers, understand I have no idea what the future will bring. I don't know if the S&P 500 will compound at 6% for the next 46 years or 14. I can't know. But I do have some strong beliefs about the implications of putting together portfolios that include a lot of other asset classes and a certain amount of fixed income. And so when I look at the top of this fine-tuning table here, I see the annualized return of an all bond portfolio is that 6.2% that I mentioned. Then add 10% in equity, 10%. And 90% in bonds, and look what happens. The return goes up to 6.8. You have added 0.6% to your return. You add another 10% in equities, and what do you end up with? Now you have a 7.4% compound rate of return. The difference between 10% and 20% equity is another 0.6%. And you do it again, it's another 0.6%. And you do it again at 40-60, it's 0.6%. It is only when you get to 50-50 that instead of adding 0.6% to the total return over the entire period, that it's 0.5% rather than 0.6. And the point is simply this, that to the extent that we're struggling, what can I control? What can I do to get me where I want to go or need to go? What can I do about dealing with losses along the way? There are all these steps that we can take, imperfect steps, but you take a bunch of them. But one thing I can say when I'm talking to young people is if you go into a target date fund, almost every one of them will have 10% of the portfolio in bonds. And I tear my hair out. I mean it. It drives me nuts. How can you have a 22-year-old kid, 10% in bonds? Having that 10% is not going to protect them from a bear market. They're still going to suffer a bear market, but it does keep them from getting 0.5% that they should get if they didn't have those bonds in the portfolio. Also, you'll notice the standard deviation here, volatility, the higher the number, the more the volatility. And I do find it is interesting that the S&P 500 has approximately double the volatility measurement as the 50-50. And the compound rate of return is about 1.2% different. I'd rather have the 10.3, but not at 72, because I want defense. I want to take a lower. I actually want a lower rate of return, because along with that higher rate of return is the possibility of a wipeout. And I mean that. Is the possibility under certain conditions, and I will show you in the next segment, that under certain conditions you will, in fact, be wiped totally out. Now, then there's a thing called a bear market. That's about losing money, and I want to look at the bottom half of this page. Notice every time you see a red number, that means you lost. You didn't lose forever. I tell anybody who wants to consider doing business, when I was an advisor with me, that I could absolutely guarantee if they follow my advice, they will lose money. I guarantee it. And every advisor should guarantee it. And if we guarantee it, then smart people like yourself are going to say, okay, if you're going to lose me money, how much and for how long? Because that has to be part of the decision-making process. Remember those Dalbar results? The public made 3.8% or something versus 10.4% for the S&P 500. One of the reasons that the returns were so low for the individual investors is because they tended to bail out when the market was down and dirty. So I always believed I should show you what I think is going to happen to you on the downside. Expectations. And I see, for example, in this combination that my wife and I have, the 50-50, that if I look at the worst 12 months, there's a loss of 28.5%. And that wasn't a calendar year. That was a consecutive 12 months. Because that could happen from July to June of the next year. That's a lot. Not going to happen very often, but that's a lot. And I've got enough fixed income in there to bring it down to that, because if I owned the S&P 500 or the 100% equity portfolio for the worst 12 months, you would see losses of 41 and 51%. How would you like that in retirement? And after you go through that loss, you don't know that there's not going to be more. Even going out 60 months is not pretty with the 50-50. A compound rate of return of a loss of 0.5% a year. And we're taking money out to live on. Whoa, that's unsettling. And it should be. But I don't care where you are on this table. When you look at the worst 60 months, nobody's going to like it. Even if you're all equities, you're not going to like that either. There is I don't know who came up with this saying. At one point I thought that I actually did, but I don't think that could be. The quote is something like, "You should never take a risk for which there is not an expected premium." You should never pay a higher fee to be in a mutual fund unless there is a belief you're going to get a higher premium. You should not go into stocks over bonds unless you're going to get a higher premium over time. And every one of these columns represents the potential for additional premium. But when we are retired, there is a peace of mind aspect of that decision. And I will show you in a few minutes how I think we should be dealing with that. I want to talk a little bit more about bear markets. There's a lot to know about bear markets. They're devastating to people because people hate to lose money. One of my favorite books is called Your Money and Your Brain by Jason Zweig. It's a wonderful read. It's all about how crazy we are about money and the things we believe that are totally false. But people demand, if they're going to lose money, to make unreasonable levels of returns. Otherwise, they'll say, I'm not going to take the chance of losing money. But bear markets are normal. It takes a 20% decline before the industry even calls it a bear market. And it gets a little more technical. They'll say it has to be for at least 60 days that it's down that 20%. The average bear market happens about every 3.5 years, going back to 1929. The thing I like about the portfolios that I recommend and others that use mutual funds or ETFs is there's never a case where you lose everything in a bear market. It's a diversified portfolio. 10 to 15,000 stocks for me have to go broke before I lose everything. With individual companies, you can have a permanent bear market. Enron is an example. WAMU is an example. Eastern Airlines is an example. There are lots of examples of companies that sustain permanent bear markets, but not with the broad indexes. The average loss, 35%. The length of the bear market on average, 10 months. On the other hand, bull markets go on, the average is 31 months. The average gain, instead of a loss of 35, is a gain of 107. Now, right now, a lot of people are very nervous because the bull market we're in right now has gone on for about 86 months. And the market's up about 250%. So what I've done so far is I have covered what I consider to be the equity asset classes you should own. I have covered what I think you should consider in terms of determining how much in fixed income and how much in equities. I want to make sure that you reach your goals and have the peace of mind to stay the course. My next job is to tell you about the funds I believe. I'd like to say that I know, but I certainly believe you should hold in your portfolio. And I don't think there are many people anymore who disagree with this. But I just looked at a friend of mine's portfolio. And everything he has, it's almost a $3 million portfolio. Everything he has in one way or another is being actively managed. And the fees are terrible. He would kind of qualify from what he's been through for being like somebody who was investing back 50 years ago, where Wall Street automatically was going to take about half your portfolio over your life, at least. And I think it's happened to him. And we're in the process now, and I don't work for a living anymore, but I can't say no to a friend. So I'm helping him do this. And what he's going to end up in are the very kinds of funds I want to talk about now. Index funds, passively managed funds, funds that make no attempt to be smart. It's a strange thing because people intuitively believe it's one of the 100 myths. I have a list of 100 myths, and one of those myths is that smart people can make more money. And it turns out that dumb people make more money as long as they are smart about staying the course for the long term and smart about putting the right asset classes in their portfolio. Now, the people who say they can time the market, the people who say they can outpick the market, are fighting an uphill battle because the academics have shown that 90 to 99% of the money that you make is based on the asset class you're in. So if that's the case, why spend any energy trying to beat the market with a high probability of underperforming the market? I mean, this is the part that doesn't make any sense. About 10 to 20% of funds will beat indexes, let's say, over a year. And that's being generous to the actively managed funds. And so why would you take the chance of being in the bottom 90 or the bottom 80%? Because you think somebody is smarter than the market. At the end of this presentation, part of the PDF that by the way, I hope if you haven't printed it out, you will print it out. There's a button there you can push right now and you can print that out. But are 30 of my favorite quotes, and several of those quotes are about the likelihood of active management doing better than passive. The odds are against you. And haven't you heard in your life people tell you that you should never invest in something you don't understand, whatever it is? Well, what's easier than an index fund? There are 500 large companies. They're in the U.S. They are mostly growth, some value. They are chosen by a committee, and it's called the S&P 500. And they have no idea which of the stocks are going to drive it to higher prices in the future. And it all is built on the basis of capitalism winning in the long term. That's all there is to it. Well, I've tried to add some things here that I would like you to know, like how much you're going to lose along the way in order to get what you got coming over the long term. It's easy to understand. Small cap value, large cap value, easy to understand. Emerging markets, piece of cake. And they come with a guaranteed return. Now, I've made an earlier guarantee that if you follow my advice in the equities market, I guarantee you'll lose money. I also guarantee that you will get market rates of return less a very, very small expense if you invest in index funds. And what's not to like about the market returns historically? 10% for the S&P 500? Forget about 16 with small cap value. Would you be happy with 12? Would you need to try to find somebody who can beat the market? Let me tell you about a fund that beat the market. Over a 10-year period, Morningstar did this study. CGM Focus compounded from about, 89 to 99 or something like that, or to 98, compounded at about 17% a year. That is what the mutual fund did. And it was better than almost any other fund in the business. But it doesn't matter what CGM Focus made. The question is, how did the people who were in CGM Focus do? Because shareholders have a tendency to want to buy when prices are up and not want to buy when prices are down. Everybody knows that. So how did they do over that same period of time? Well, they didn't do as well. While CGM Focus made 17, the investors only made 16. The problem is the 16 was a compound rate of return, and it was a negative 16. It seems almost impossible that could happen. But people in the process of chasing performance have this tendency to do something that is not in their best interest. My presentation here is all about what's in your best interest. And I believe that those of you who may believe yourself that you can do better than the market if you just find somebody smart should take a look at the returns of the market long term and ask yourself, is that enough? Index funds have low expenses. Index funds are more tax efficient. And there's more. You get more diversification. This 10 to 15,000 stocks I own. By the way, I love owning that many because if I go to a party somewhere and somebody says, boy, I love that Apple. That's a great company to have in your portfolio. I've got some. I'm making money, they'll say. And I'll say, I agree. And I have some Apple in my portfolio too. And almost any stock they can bring up, I got some too. So I have great pride. By the way, it's false pride because I have some fact. I don't even really know if Apple's in there. I believe it's in there, but I don't care because I got 10 to 15,000 companies. That extra diversification is golden. If they could make more money with less diversification, I'd be all for going for undiversified funds. But the fact is, the studies show that diversified funds, more diversification, has historically actually led to higher returns, not lower. It doesn't make any sense because the smart people are the ones who are not as well diversified. And I don't know if you're a controlled person like I may be, but I do like control. And when I build a portfolio and I want some small cap and some large cap and some value and some growth, I like control. I like determining how much I want in U.S. and international. I don't want somebody else telling me how much I want. I know what I want because I'm following somebody else's ideas, the academics. So when you use index funds, you have control. You're not going to get international stocks in a U.S. index. You're not going to get large companies in a small cap fund. It happens in actively managed funds. It happens. Not unusual. And I love, but I don't love this, I hate it. But I find it very interesting that, there's a report, SPIVA, it's an S&P report that comes out. And in the SPIVA report, it comes out I think twice a year, they show past results of indexes versus actively managed funds. And one of the things they track is how many of the funds that were there 10 years ago are still here today. So when they look at the results of the funds that are still here today, there is what they call a survivorship bias because they're not including the funds that folded or merged away. For what reason? Well, I would guess for almost every reason, because of poor performance. So when they talk about the performance of that 60% that are left versus the index funds, what we know is the index funds end up over 10 years in the top quartile. And we happen to know that the funds that are in the top quartile outperform the next quartile down by about 1% a year, and the next quartile down by about 2% a year. Now, I always want to go back to that idea that 0.5% is life-changing. So if index funds do end up in the top quartile, and part of that's because the expenses are lower, but all these good reasons, more diversification, doesn't matter how they get there, it seems to be dependable. And the fact that you don't have to stay on top of him and see what the manager's up to. Is the manager, does something going on? Maybe he or she's not feeling well. That's the reason for the poor performance lately. I don't know. I don't have to know with an index fund. And I absolutely think it is wonderful when I do something in my life that experts agree with me. I am a very insecure person. I was actually raised in an environment of physical abuse. Now, that doesn't make me a good or bad person, it's just what I went through. But when you were raised in an environment of physical abuse, there's something that you want to be, and what you want to be is right. Because when you are wrong, it's not a pretty picture. And when Warren Buffett leaves 90% of his money to his wife in the S&P 500, an index fund, and when he says to the public, and he said this many times over the years, when he says that investors, whether they are retail investors or professional investors, they should all use index funds. And guess what's been happening? Pension funds are moving more and more to index funds. And with Charles Schwab, one of my heroes because he started one of the first discount brokerage firms, and he cut the cost of doing business, putting more money in your pocket. And he was made to look like maybe he was part of the mob or something. How could he possibly do this? It was an outrage what they tried to do to him. But he survived, and as John Bogle did with Vanguard, helped people put more money in their pocket. And he advocates mutual funds and ETFs. And Daniel Kahneman, Nobel laureate, all about how the market is inefficient, and if it's inefficient, that means that those of us who are smart could figure out how to take advantage of those inefficiencies and make extra money. He advocates index funds. and admits, yes, the market is inefficient, but I have no idea how to take advantage of it, and it doesn't appear that very many people do. So now you have my advocacy for index funds. You have my work on fine-tuning for how much in fixed income and equity. And now, in the next segment, in about 5 minutes, I am going to give you what I think is some of the most important work I've ever done. It will be almost all about distributions and how to turn $3,000 into $50 million. Thank you. Well, as I said earlier, the distribution decisions are every bit as important as how much we save, where we put the money, how much in stocks and bonds, all of those things that we've covered up to this point. In fact, most people don't spend much time on the distribution part because most people seem to kind of wing it in retirement and just adjust their lifestyle to whatever happens to their portfolio. I believe that we'll be way ahead if we're more intentional about that process. I do know from a recent survey that only 24% of the people surveyed, ages 53 through 69, believe they are going to have enough money to last the rest of their life. And that's potentially catastrophic. Now, obviously, what it means for a lot of people is a lot different lifestyle than if they make some decisions that might bear more fruit. So how important is this distribution strategy and decision? Well, the bottom line is, I don't know how you can know how much money you need to retire until you know how you're going to take money out. That's obvious. And that means you have to decide whether you're going to build for cash flow for basics, or do you want cash flow for more than just the basics? And I will show you two strategies, one that is designed for the basics. By the way, your basics may be to go on one trip a year, vacation. But for somebody else, it may mean doing more, doing 3 vacations. Costs more money. Some people want to leave money to children and charities. Some people don't. And I certainly, when I was an advisor, I loved the discussion with a couple and how to get the saver and the spender to come together and be happy with that distribution strategy. And as we go through these, I know the variables that you're going to be dealing with, because in my case, here we got a question. Are we talking about the money needs to last 10, 20, 30, 40 years? In my case, it's about 20 years, so I kind of look at 20 years when I'm looking at these tables. Do I want to retire right now with just enough, or do I want to try to retire with more than enough? In my case, my wife and I worked until we had about twice what we really needed, so that we could retire and take out more. I'll show you that in a few minutes. Are you going to try to have enough to live well and leave a lot, or live well and leave less? You know, the old I want the last check to bounce idea. Very few people really want that, but some maybe do. And what I find it is most important is some sense of a guarantee that I will not run out of money before I run out of life. When I wrote Live It Up Without Outliving Your Money, that was the whole idea. How do you maximize the fun and minimize the risk? Fortunately, I know you like numbers. At least I hope you do. Because what you're going to see, again, are a series of tables. Each one is trying to kind of teach a lesson and help you make a decision, or help a client make a decision. What you'll notice is that the table is headlined very conservative. This is a very conservative distribution schedule for somebody who's on a fixed distribution. What does fixed distribution mean? It means probably that they are retiring with enough. They're not saving extra. They cannot wait to get out of the job. I remember talking to two teachers way back in the late 90s. Teach down in Oregon, and I said, well, why do you want to quit? And I said, well, we have 3 reasons. We hate the students, we hate the administration, and we don't particularly care for the other teachers. They were so anxious to leave. On the other hand, I loved what I did. I actually love it even more now that I spend my life teaching and helping people and advisors take better care of their clients. There's no pressure, except the information's got to be right. And I really enjoy doing it, and I'm happy you're there to do it with. Table 1, very conservative, $30,000 on $1 million investment. $30,000. That's a 3% distribution, but because you have not got extra money, you need to adjust that upward every year for inflation. So on the right-hand side of the table, what you see is the inflation 1 year at a time going back to 1970. Whoa, there were some years of very high inflation. 1978 through 1981 looks like about an average of 11% a year. If you didn't go through it, you can't believe what problems it caused for people. And I suspect we will again someday. Now, I instead of looking at all of the combinations that we had in the fine-tuning table from 10%, 20, 30, 40, 50, etc., equities versus fixed income, I focus in on the 3 that when I was an advisor were most common: 40% equity, 50% equity, and 60% equity. And I throw the S&P 500 in there just because that's that benchmark. And if you started out with a $30,000 distribution, what happens is every year it goes up because there was inflation every year, and at the bottom of the page, your 1989 distribution was $96,000. Think about that. Tripling your need for money out of a portfolio because that's what you needed to have in order to keep up with inflation. I suspect a lot of people did not keep up with inflation. And at the end of this 20-year period, the one that's 40% in equity ended up with 4.5 times what they put in, and they got the income. The 50% ended up with 5.4, so almost $1 million more because of an extra 0.5%. Remember that? An extra 0.5%, 8 versus 8.6, well, 0.6%. And then the 60-40 ended up with 6.4 million, even more because you made another 0.5%. What's kind of interesting is the S&P 500 ends up with 3.8 million. You did better being in an asset class that while it made 10.3% over the long term, your lower rates of return that came with lower exposure to risk paid off handsomely, not just in terms of money, but peace of mind. At one point, notice 1974, the S&P 500 got down to $761,000. I've sat with a lot of couples, and I don't know many retired couples that would sit there, having put in $1 million, have taken money out, but now you're down to $761,000. I'm thinking maybe they're going somewhere else. It's not just enough to get the return. But you got to let people be able to live through it. And if you had your money with some fixed income, you basically stayed kind of even. More of Table 1 from 1990 to 2009. Well, from 1990 to 1999, as we talked earlier, the S&P 500 did well, and you can see it here because all of a sudden, from being way behind, the S&P 500 at the end of 10 years now has 16.7 million versus 7, 9, and 12 million at the 40, 50, and 60% equity. This is something you can't know is going to happen. But that's an amazing move over that 10-year period to go from about 3.5 million to over 16. But you can see by the end of 2009 that the S&P 500 now is back down while the 50/50 is still up more. Now, if we knew the future would look like the past, there would be no decision to make, would there? Well, maybe it depends, because we need to see one more piece of time. And it turns out when you add the next piece of time that in fact the S&P 500 is back on top. Of course, it's highly risky versus the 50/50, the 40/60, the 60/40. Not nearly as risky. They're all risky. But do notice that the 60/40 ended up with more money than the S&P 500. And by the way, I want you to note the $5 million, the total distribution, $4.98 million. I want to remember that $5 million. We'll refer back to that. Now, table 2. Conservative. We were very conservative last time. Now we are just conservative because now we're going to take out $40,000 instead of $30,000. And honestly, investors, your clients, or most investors, maybe even most CPAs, don't know how a little change, whether it's a little change in asset allocation. Remember that extra 10% equity, what it did? Turned out an extra 0.5% or 0.6%. Now an extra 1% in the distribution from $30,000 to $40,000 on $1 million portfolio may not seem like a huge game changer. But one thing we know that it's going to do, as you can see here, is that in 1974, you had less money left over because you were taking more money out. And all of your inflation adjustments are on that extra $10,000. That's going to cost you in the future. In fact, you may remember at the end of the first 20 years, the distribution was about $96,000. Here, it's $128,000, taking out $40,000 instead of $30,000 to begin with. And notice, too, how much less money is left at the end of 1989. The S&P 500, instead of having 3.8 million, when you took out 30,000, is down to 2.1 or 2. And the 60/40, instead of having 6.4, is down to 4.6. It's costing you that extra $10,000. But then, of course, the market gets better in the 90s, particularly for the S&P 500. So they were doing fine by 1999. And in fact, if you look at the 60/40 compared to the S&P 500 in 1999, the 60/40 had more, but the S&P 500 had gone from about 2 million to 6.5 million. You're looking pretty good. And remember, that was the point in time when people were predicting the S&P 500 should make 20 to 30% a year for the next decade. Well, we talked before, no, it didn't. It actually lost 1% a year. So as you get down to the end of this 20-year period on this table, notice the S&P 500 now has 3.8 million. The 60/40 has 11 point something million. The 50/50 almost 8 million. And the 40/60, 4.7 million. They're back on top. The conservative strategy. And then you can see what happened because the market was pretty good for the S&P 500. It did okay 2010 through 2015. ended with 5.7 million. You may forget, but the final figure at the previous table where you took out 30,000 was 26.7 million. A little change in how much you take out. Now, maybe you don't consider $10,000 as a small change. I think my spouse would. They certainly wouldn't expect that at the end of all this time, of course, I'm not going to live this long, of course, but the bottom line is to have a 20 million plus decline in value because of a lousy $10,000 a year doesn't seem possible, but it is. But I'm going to show you what I'm doing with my wife. We're taking 5%. And I want to show you what happens when you take a fixed 5%. And you'll understand why we are not taking a fixed 5%. First of all, notice the S&P 500 in 1974 is down to $677,000. That's unfriendly. If you go all the way down to the bottom of the page, you'll notice it ended at $498,000. And the other ones aren't faring so well either. At 4%, the S&P 500 at this point had 2.2 million. Now it doesn't, by taking out that extra $10,000. And as we move to the next page, it's ugly. There in about 1993, January of 1993 probably, as the money is totally gone, you're out packing up the van to go move in with your kids. Think about that for a minute. And that would be true with the 40/60. You run out of money. Now, I know you're not going to sit there and let this all happen, just blindly run out of money. But you can see the problem. You're taking out too much. You're overtaxing, if you want to call it that, the portfolio. And as you go to the next table, there's only one of these columns that makes it to the bottom. And all you did, this is important, all you did was change the distribution rate. You didn't change the stocks in the portfolio. You didn't change the bonds in the portfolio. You didn't change the balance of stocks and bonds in the portfolio. So every one of these things, whether it's the rate of distribution, the asset allocation, what stocks, equity asset classes you have in your portfolio, I guarantee you, looking backwards, that had you done this same set of tables, and I'm going to do it this year to show people, if you'd done these same set of tables with the S&P 500 only, the outcome would be very different. That little extra bit of money that you make with a more broadly diversified portfolio makes a huge difference over time. Now, I'm going to take more. Well, we know it's crazy, right? If you run out of money at 5%, it won't surprise you. All that's going to surprise you is maybe how early, by about 1985, you're out of money with the S&P 500, and by about early 1990s, you're out of money in the 40 and the 50 and the 60% equity positions. And every time you run out of money, not only do you run out of money, but it stops growing for others. I mean, this is important for those of you who want to leave money to others, whether it's children or charities. In my particular case, when I die, all of my IRAs go to my foundation. And in fact, every year, because I'm 72, I can take that money out, put it directly into my foundation, get a write-off for that money. It's an operating foundation, so that's appropriate. And I want that money to grow and do the same work I'm doing for right here today, but somebody else will be doing it. By the way, my son has told me he will. And I love this, A young fellow who could be a future son-in-law, don't know. Maybe by the time you see this, he is, I don't know. But he's had an offer from Vanguard, and looks like he also has an offer from a company called DFA. He could be next in line in continuing the foundation's work. I know that's not your problem, that's mine. But what we do know is as we go to 60,000, there's a whole lot of time that nobody's making anything because somebody took out too much money. Now I want to talk about a strategy that is very different. Now, it doesn't seem very different because there's really only one change. There's only one change. We go from being a fixed distribution to being what we call a variable or a flexible distribution. And this is not for people who retire with just enough, because they don't have much flexibility when they retire with just enough. If inflation goes up, if they want to maintain their lifestyle, they need to make an adjustment and take more money for inflation. But what about somebody who saves more than they need? I mentioned earlier that my wife and I tried to save twice what we knew that we needed, so that instead of using a fixed distribution, we could use a variable, where my payout doesn't have to go up every year by some inflationary amount because I'm taking way more than I need anyway. And the market can go down some, and okay, the next year, because the market goes down, I take 3% this year. The market goes down, I take 3% of a lower number. The market goes up, I take 3% of a higher number. You roll with the punches. Now, it also solves an interesting dilemma for couples like my wife and myself. My nature is to be frugal. You can't see the pants I'm wearing right now, but I suspect they're 20 years old, okay? I'm frugal. And I enjoy life and I enjoy travel, but I'm not a spender. My wife legitimately says, what is this money for but to spend and enjoy? So what happens to me if we didn't have an arrangement, an agreement, a plan? The plan is when the market goes up, you get to spend more money. When the market goes down, by the way, that's good for her. When the market goes down, because we take a slightly smaller chunk of money out of the portfolio, it makes the money, it's a defensive strategy. It makes the money produce more in the long run because you leave some in there. And you might say, come on, Paul, it isn't going to make that much difference, is it? Yes, it makes a world of difference. It actually makes an unbelievable difference to add this one defensive step. Now we've got all those defensive steps from lower expenses, lower taxes, more diversification, blah, 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 and we have one last one, and that is a distribution strategy that defends against the harm of a bear market. And I don't expect to move into another house because of this decline, but I just want to live on a little less. But my wife knows that 2 out of 3 years the market goes up. She is in the catbird seat because she's going to get more raises than I'm going to get cuts in pay, okay? Let's look at it. All I'm showing here is the 50-50. I'm not showing all those different, because I have to use 3 columns, because every strategy is going to have different distributions, because every strategy, the balance of fixed income and equity, is going to lead to a different distribution each year or a different value each year, and then I take a percentage. In this case, it's 3%. And you can see what happened here. You can see, for example, in 1975, the payout for the distribution for the S&P 500 was 22,900 approximately. Whoa, that'd be a cut in pay. But by the way, if I had twice as much money in here as I needed, then 2 times that would probably cover my cost of living. And with that same year, the distribution in the 50-50, which is what my wife and I have, you'll notice would be about 30,000 instead of 22. So all of these defensive things piling in together at one time, giving this huge advantage to the more conservative strategy. Next 20 years. Well, the S&P 500 comes roaring back. So by the end of 1999, there's over $19 million there versus about $8.8 million in the 50-50 strategy. Huge advantage to the S&P 500. And of course, people are saying, well, gee, I wish I had. Yeah, of course you wish you had. And you can see that the distributions are getting pretty big. In 1999, the distribution from the S&P 500 was $486,000. The distribution from the 50-50, $250,000. Now, those of you who really like this kind of stuff, when you get done with me here and you have some time on your available, you're going to sit down, you're going to compare these tables. I just know you are. And see how did the distribution year by year differ with the variable versus the fixed. But if we look at the end of this period of time, I want you to remember, I told you we got to remember a number at the end of that last distribution. The 3% distribution was about 5 million, 499 something. So here I'm looking at the distribution using the variable strategy, and I notice that the distribution cumulative from the S&P 500 is $10.9 million. You just doubled the income you took out of this portfolio by going to the flexible, but it did require that you cut back during the worst of times. And instead of $5 million cumulative under the 50-50, it's 8.9. And remember again, the strategy of 50-50 is about half as risky as the strategy of the S&P 500, but that 8.9 is not that far away from 10.9 when you consider how much less risk you took. Now, when we look at Table 6, which is the conservative 4% distribution, flexible now, not fixed, of course, you'll notice that down at the bottom of the page at the end of the 20 years, it's getting lean. And of course, as you might expect, because the market came back, the next 10 years you get well. And by the end of 2009, you're hanging in there, you're doing fine. You've taken about 7.8 million or more in the S&P 500, 6.6 million in the 50-50 in terms of distributions, but you're still in there getting money. And then, by the end of this time, 2005, taking 4%, you're not leaving as much money to your heirs. This is an important aspect of this. Now, here. You save more than you needed. So already you're likely to give your kids more or charities than you would have if you hadn't saved more than you needed. So maybe you shouldn't have to apologize for enjoying more money. But what I see is the year-end balance at the 50-50 is 8.3 million, and that is down from 14.5 million you would have left your charities and children under the previous fixed distribution. Or the same 4% fixed distribution. You would have left more money, but you would have had less money to spend. Now we're getting into dangerous territory. And this is the territory I just love. Because the beauty of the flexible distribution is that it increases the odds of your money lasting. And it allows me, instead of taking out 4%, I feel very comfortable on behalf of my wife and myself taking out 5% a year because I started with more than I absolutely needed. So if you look, for example, at these two, this table, and you look down at the bottom of the table at the end of 20 years, you will see that the year-end balance is about $3.6 million. You're leaving less to heirs, and with the S&P 500 about $3.2 billion. Again, less to heirs than the previous distribution strategy. But I want you to see something here in the next page. I want you to look at 1994. In the 5% distribution strategy in 1994 with the S&P 500, you were flat broke. You did not get any more of these distributions. Your heirs did not get any money left to them at all because you used all the money. But by being willing to go to a flexible instead of a fixed distribution, it left all this money here, and it goes all the way over to the next page. And not only are you happy, but your kids are happy too. You didn't have to move in with them. There's a celebration right there, huh? As we move on to the 6% distribution, we saw before everything failed. Everything failed. Let me just take you to the bottom line. The bottom line is everything makes it to the bottom line. All the money gets distributed. You do not go without. Your children do not go without. And yet you could conservatively, I say conservatively, if you oversaved, you could take out 6% a year. That choice of what distribution, what asset allocation, what choice of equities, all these things tumble down and they compound either fairly or poorly to your financial future. I want to talk a little bit about successful investors. I'm going to make this quick because I want to make sure I have time to show you how to get $3,000 to $50 million for your child or grandchild. I want you to see this table because I want you to realize how much luck has to do with your return. I want you to notice the period 1960 through 1974. The S&P 500 compounds at 4.3, the small cap value at 6.8. It was not a great period for investors. And if that's when you started, the first 15 years looked pretty limp. Same thing happened from 2000 to 2015. 4.1% compound rate of return. Small cap value did 12.4. Whoa. Nice to have some of that in there, huh? But from 1975 to 1999, the golden years of investing, you looked like a genius. Maybe after that particular 25-year period, you could retire. You wouldn't have to work 40 years because you had such a high rate of return. Luck. Pure luck. You can't control when you're born, when you got your job, and when you got enough to save. You just need to do it. And quickly, I want to share the idea of selecting an investment advisor. I look at 3 levels of advice and service. From the advisor, I want competence and I want ethics. From the firm that the advisor works for, I want competence and I want ethics. And the products that firm represents and recommends, I want ethics and I want competence. And you might think, oh, doesn't everybody have that? Do me a favor if you want to test just the firm. Of course, The guy, the person, the lady, whoever's taking care of you, your advisor, they're wonderful. But what if they work for a firm that when you put the name of that firm in there and put the word fraud after it in a search engine, millions of results come up and they pay billions and billions of dollars in fines? Is that the kind of firm you want somebody working for who's serving you? I think not. A pie graph. Picture a pie graph. Everything within this pie graph is what you need to know to be a successful investor. There's a piece of pie that represents what you know you know. It's important. Hopefully today you know more than you knew before. That would make me feel good. Email me and tell me whether this was worthwhile in terms of learning something important. Then there's a piece of pie that represents what you know you don't know. Mostly that's about the future, I suspect. Then there's a piece of pie that represents what you don't know you don't know. And because you don't know it, you can't know how big a piece that is. Then there's a piece that represents what you know, but you're just flat wrong. It's called a myth. Then there's a piece, and this is important. You know, but you don't do anything about it. My goal is to get you to do something about it. The articles I write, the podcasts that I do weekly, these are all about getting people to move to action to take care of themselves. Let me just give you one example. I told you a while ago that target date funds do not have enough small cap value in them. Not enough. What would happen if you added some small cap value because you were convinced that there's an advantage to small cap value? Well, if you added small cap value, not only would you fix the small in those target date funds, but they are also underrepresented in terms of value. So if you added 25% to the portfolio and you put the money in the target date fund, 75% of your savings, 25% goes into a small cap value fund. And you can see over a lifetime of saving that the person who just uses the target date fund ends up under my set of assumptions with about 3.8 million versus 7 million. And there's an article that you have a link to in the supplementary information there that you can go read about that. But that is putting something to work. In fact, if you need help figuring out what funds to invest in at Vanguard, Fidelity, T. Rowe Price, ETFs at Schwab and TD Ameritrade, Fidelity and Vanguard, I have free recommendations on my website in the hope that if you believe everything you've heard up to here, that you could put some of this to work in your own portfolio. Legacy for a newborn child. I think this is a life changer. And it's simple. All you do is you take an amount of money, and I'm assuming the child is now newborn from day one. You put away either $365 a year or $3,000 once. You let it build up in an account. I would recommend it stay in your name. There is an article about this particular strategy that I've given you links to as well. But you keep that in your name, and then when that child starts earning money, you start taking parts of that and you put it into their Roth IRA. And then you use it until it's gone. So what is the possibility? What could happen? Well, let's say that you put that money into an investment that compounds at 10% a year. You can see in the middle table, that's the $365 a year for 21 years. Between the distributions and the money that's left at age 95, and people being born today have a high likelihood of living to 95 and older. So you get that into a Roth IRA. Who knows if the government will allow that to be a tax-free distribution? I can't say. But if they do, as they do now, that total distribution, if you got a 10% compound rate of return, well, where might you find 10%? Well, maybe if you put your money into those four funds, the S&P, the large cap value, the small cap value, the small cap blend. It would be legitimate to get a 10% or more, I think. When you go to 12%, if you're going to shoot for 12%, what I believe is you would put this money into small cap value. Now, you might eventually spread it between small cap value international and U.S. You might even have a component in small cap value or it's not actually small cap, but value in emerging markets. I think you've got a legitimate shot at 12%. So what would happen if that money compounds at 12%? Well, you can see that the total distributions in retirement would be over $20 million. And what you would have left for heirs would be over $30 million. And if you want it to be worth a little more than that, what you could do is convince this kid at age 21 that they should continue to put that money away at $365 a year, regardless of what they're doing with their 401k. In which case you pick up another $5 million or so. For a lousy $365 a year for either 21 or 65 years. Now, I remember making a similar presentation years ago, not with this strategy, and somebody said, well, that's an awfully long time, isn't it? Well, yeah. I mean, that's the whole idea. What is the one thing I have heard more times than other when I have finished my presentation? Somebody invariably comes up and says, damn, I wish somebody told me that 50 years ago. Here's a chance. Now, I do expect you to try to motivate them, and I've done some writing about this, but motivate them to want to save for the future, because this will be a test of delayed gratification, right? I think it's wonderful. What I did, and I don't think I did the best thing, but it's done. As each one of my grandchildren were born, I put $10,000 into a variable annuity under what they call a crummy trust, which can't be touched under the terms of the trust until they're 65, and then they get 5% a year. The problem is I would have been smarter as I think about it now if I'd put that money away until they could qualify for a Roth IRA and funded that $10,000 investment until it was gone. But I did what I did. So those are some of the most important investment decisions that I know. I'm doing everything I can to try to help people do better. I want you to tell me if I'm wrong. I want people to email me that there's something wrong with what I've presented, because I'm going to do an article about those things that I said that you didn't agree with, and I'll address them. Of course, I'll never use your name. The articles I write, I hope you'll read. The podcasts, I hope you'll listen to. I've given you in the handout material a complete list of links to what I think are the most important articles that I've read in helping people with what I consider to be evergreen topics, things that were meaningful a year ago or 5 years ago and still are. Like how to double your retirement income in 5 years. It was the first article I wrote for Market Watch, and I think maybe one of the best. I respond to emails. I do want to hear whether this was helpful to you, and I hope somehow you're able eventually to share this video with your clients. Or if you have other ways that you think that I could be helpful in you educating your clients, you are welcome to steal anything you want from my website. I would love it if you give me credit. But I want to pass this information along to others. Thank you for taking approximately 3 hours, valuable hours out of your life. I do hope it was worthwhile for you. And as I said in the beginning, this doesn't get any better for me. It is an honor and a pleasure to have a chance to to share information that I know it's people that are doing the best they can for their clients. Thank you, and good luck. All the best.